Yolanda, we're seeing this ongoing risk aversion that seems to have come to the fore again this week. So just last week when everything seemed fine, that seems to be out the window at the moment. We had Greece's sovereign debt downgraded by Fitch yesterday, and that's just the latest news to spook the markets.
Stephen, quite interestingly, South Africa has the same BBB rating, which is an emerging market, and Greece had been upgraded from emerging to a development market, and they really didn't seem to make it. I think the concern with the markets today is that there are a couple of rumors out there that potentially that Greece is not the only one that is going to be defaulting. And that's really just setting jitters amongst investors. And when one looks at Europe, it is our biggest trading partner. It really doesn't bode well for us, because the EU will obviously look at focusing on its own countries and really support its own countries first in terms of exports and imports. And therefore, really, the SA will come under pressure in terms of our export side, and that really will lead to possible rand weakness in the short term.
Of course, you said other countries also at risk. We've heard stories about Spain, about Ireland. We know that Turkey, which is outside of the European Union, is also under pressure. And of course, the European weakness is filtering through to the euro, which is also helping to bolster the dollar. And of course, that's putting our commodity prices under pressure. So it's really resources stocks and commodities that are suffering the most on the JSE today.
Yes, Stephen, if one looks, I think it's a mixed bag of there's probably a lot of panic, a lot of profit taking coming off. We've seen a lot of surprising, a lot of volume on the day, and possibly. The other news that came out today, which was quite concerning, and we saw it coming out of Asia, was that Japan missed its GDP forecast. So really, it just seems that there are a lot of pockets coming out from different sides of the economic world. So a lot of concern.
Yeah, so it seems, I think, that we were just getting a bit too complacent that the recovery was on track, and now we're starting to question just the pace of that recovery. Is that right, Yolanda?
Yes, Stephen, and usually in terms of markets, we usually have a dip. Negative news comes out, and then we seem to always get some positive news out. And if we look out today, there's no positive news, so there's a lot of bearish, and there's nothing to support or kind of counteract the negative news that's coming out. So we're possibly going to see more weakness further into the rest of the week. And if those jobs data, like I mentioned yesterday, the continuous claims that they will be coming out a little bit later, we possibly could see further weakness if those jobs data don't come out as positive as the market expects.
Of course, we started last week on the back foot, really after the Dubai world debt problem came to the fore. That seemed to have died away during the course of last week. This week it's back in the front again. Dubai world's debt, and of course the $3.6 billion loss at property developer Nakheel, and they're also spooking the markets. What do you think the knock-on impact of that could be for South Africa? Because we know some of our construction companies have quite big exposure to Dubai.
Stephen, when one looks at the local construction stocks, Wilson Bailey and Murray's, have limited. They don't have any new contracts out in the Dubai area, and they do have, in terms of possible monies owed to them, but not a large exposure. So in terms of our local stocks, we're looking forward, in terms of 2010, the construction. There is concern, though, when we look into 2011, that they aren't really getting any new contracts post 2010. So a concern, they're obviously going to have a good 2010, but beyond that, a little bit of risk.
And of course, I'm sure Dubai was one of those markets where they were looking for contracts. Yolanda, we had those retail sales figures out just a very short while ago. 6.5% contraction in retail sales in October from a revised 4.9% contraction in September. So slightly worse than the market was expecting, and showing that our retailers are still facing a very tough Christmas.
Yes, Stephen, and unfortunately, the higher debt levels we were hoping have possibly peaked, and really we can see that consumers are probably not spending as much as they have been, and we've seen the consistent numbers coming out, and a lot of the retailers are very concerned that consumers are not coming through. If one looks at December, it's been a long year, and perhaps consumers have been putting away money to spend in December. I'm really optimistic that, considering how bad and how long the year has been, that we're going to see consumers perhaps spoiling themselves, not on luxury items, but on your cash items. So I think your Mr. Price, your ShopRites, a good Christmas dinner, those kind of counters that focus on your cash consumers and your lower income market are probably going to get the benefit of the interest rate cut over December.
Mm-hmm. Well, you mentioned a little bit earlier that today volumes appeared quite good. Of course, we are starting to see volumes tailing off as the year draws to a close. We have a public holiday next Wednesday. Next Thursday, futures close out. What are you expecting for that futures close out, and are we likely to see volumes really dwindling after that?
As even with the expectation, we're hoping to see volumes come through. If we do see a lot of uncertainty in terms of the markets over the next week, we're going to possibly see investors taking a lot of money off the table. So it might be fairly quiet, but we will hopefully see volume. But after that, it's a lot of investors are going to close off their books, go on holiday, and come back in the new year and see what the market has done.